Who really has $1 million in retirement savings? You might think that with decades of work, steady paychecks, and those 401k contributions, plenty of Americans would hit that seven-figure mark by retirement. But the shocking truth, very few actually do. And today, we're going to break down exactly why, who really reaches that milestone, and what the rest of us can do to close that gap before it's too late. Let's start with the myth. For years, we've been told that if you simply save a little from every paycheck, invest in your retirement plan, and avoid big mistakes, you'll retire comfortably, maybe even as a millionaire. That's what the financial industry has sold us. But the data tells a very different story. According to recent surveys from Vanguard and Fidelity, only about 1% of Americans actually have over $1 million saved for retirement. Yes, just 1%. Out of 100 people, only one has that much set aside for their future. Now, you might be wondering, how is that possible? We're talking about a nation with one of the largest economies in the world, yet such a tiny fraction reaches that financial security level. Let's look at the numbers behind it. The average 401k balance for someone in their 60s, that's close to retirement, is around $250,000 to $300,000. That's not small, but it's far from enough. Even if you withdrew modestly, say 4% a year, that's only about $12,000 annually. That's not going to fund a comfortable retirement, especially when you factor in inflation, healthcare costs, and rising living expenses. So who really manages to save $1 million or more? The answer might surprise you. The people who make it there aren't necessarily the ones earning the biggest paychecks, though income helps. Instead, they're often the ones who started early, stayed consistent, and avoided big emotional decisions with their money. These are people who understand compounding, that magical force that grows money exponentially over time. Someone who starts investing just $500 a month at age 25 could have over $1 million by age 65, assuming reasonable returns. But if they wait until 40 to start, they'd need to invest 3 times that amount every month just to catch up. Time is the real millionaire maker. But here's another truth that most people overlook: lifestyle inflation. As people make more money, they tend to spend more. They upgrade homes, cars, vacations, and savings takes a backseat. Many high-income earners who appear wealthy on the surface, nice homes, expensive cars, great vacations, actually have little in savings. They're what we call Henrys, high earners, not rich yet. They make 6 figures but live paycheck to paycheck. When retirement comes, they realize too late that the lifestyle they built can't continue without steady income. On the flip side, there are teachers, nurses, and ordinary middle-class workers who retire as millionaires quietly, simply because they live below their means, invested steadily, and never let fear drive their financial decisions. These are the stealth wealth retirees, no flashy lifestyle, but real financial independence. So, why do so few people reach that $1 million mark? There are a few major reasons. First, inflation. The cost of living has skyrocketed over the past few decades. What used to cost $1 in 1980 now costs more than $3 today. That means you need 3 times the savings just to maintain the same lifestyle. Many people who thought they were saving enough discovered too late that their nest egg doesn't stretch as far as they expected. Second, debt. Credit cards, student loans, car payments, and mortgages eat up income that could have gone into savings. The average American household carries thousands in credit card debt. Even a modest interest rate compounds against you. Instead of your money growing, it's shrinking under the weight of interest payments. Third, lack of financial literacy. Most people simply don't know how to invest effectively. They leave cash sitting in low-interest savings accounts or panic sell when the stock market dips. They don't understand that volatility is part of the journey, and that the biggest returns often come right after the market's worst moments. Fourth, procrastination. People delay saving because retirement feels far away. I'll start next year, they say, until suddenly, they're 50 and scrambling to catch up. And fifth, unrealistic expectations. Many assume Social Security will cover most of their needs, but it was never designed to fully replace your income. It's only meant to supplement savings, not substitute them. Now, let's talk about what $1 million actually means in retirement. It sounds like a huge number, but in reality, it's not as much as it used to be. Depending on where you live, $1 million could last you 30 years, or barely 10. In a low-cost area, it might stretch comfortably. But in big cities like New York, Los Angeles, or Miami, living expenses can drain that money quickly. Healthcare alone is a massive cost. A couple retiring today might need over $300,000 just for medical expenses throughout retirement. So even among the 1% who do have that million, the story isn't always glamorous. Many still have to budget carefully, avoid large unexpected costs, and continue investing even in retirement to make their savings last. But here's the hopeful part. Becoming a retirement millionaire isn't impossible. It's difficult, yes, but achievable if you understand the math and start applying it early. Let's break it down. Step 1. Automate your savings. Don't rely on willpower. Set up automatic transfers to your 401k, IRA, or investment account. Treat savings like a bill you have to pay every month. Step 2. Invest consistently, even when the market is down. The truth is, the best buying opportunities happen when everyone else is scared. If you keep contributing during market downturns, you're essentially buying stocks on sale. Step 3. Increase your savings rate with every raise. Instead of upgrading your lifestyle, upgrade your future. If you get a 5% raise, put at least 2% of it straight into your investments. You'll never miss the money, and your retirement balance will thank you later. Step 4. Stay invested for the long haul. The market's long-term trend is up. Every crash in history has been followed by recovery. The people who build wealth are the ones who stay patient when others panic. Step 5. Avoid bad debt. Pay off high-interest credit cards as quickly as possible. You can't build wealth when your money is being drained by interest payments. And finally, Step 6. Understand what you're investing in. You don't have to become a financial expert, but you do need to understand the basics: stocks, bonds, index funds, diversification. Knowledge compounds just like money. Now, let's look at some real numbers to see how this plays out. If you invest $500 a month for 40 years with an average annual return of 8%, you'll end up with about $1.5 million. But if you start 10 years later, you'll only have about $680,000, less than half. That's the cost of waiting. That's why the true millionaires are not necessarily smarter or luckier, they're simply earlier and more disciplined. But let's address something deeper: the emotional side of money. Because for most people, the biggest enemy isn't the market, or inflation, or taxes. It's fear and inconsistency. People invest when markets are booming and panic sell when things crash. They let short-term emotions destroy long-term results. Millionaires, on the other hand, think in decades. They stay the course. They know wealth doesn't come from timing the market, it comes from time in the market. Now let's look at generations. Who actually has the most saved right now? Unsurprisingly, baby boomers, people in their late 50s to 70s, hold the majority of retirement wealth. Many started saving in the 1980s and 1990s when the stock market delivered incredible returns. Gen X, those in their 40s and 50s, are next in line, but they are struggling more, squeezed between kids, aging parents, and high living costs. Millennials and Gen Z, they're just starting, and they're already facing higher housing costs, lower job security, and a much more expensive economy. So the million-dollar retiree is more often someone who's been investing steadily for decades, someone who didn't give up during the dot-com crash, the 2008 crisis, or the 2020 pandemic. They saw the big picture and trusted the process. But as shocking as it is, most Americans aren't even close. Studies show that nearly half of people in their 50s have less than $100,000 saved. Some have nothing at all. And this isn't just a financial problem, it's a societal one. It means millions will have to work longer, depend on family, or rely on government programs that are already stretched thin. Yet there's still time, for everyone watching this right now, to change that trajectory. Whether you're 25 or 55, the principles remain the same. The earlier you start, the easier it gets. The later you start, the harder you have to push, but it's still possible. You don't need to chase meme stocks or get rich overnight. You just need to stay consistent, invest in broad-based index funds, and let compounding do its magic. And remember, $1 million isn't a finish line, it's a benchmark. What really matters is financial freedom, the ability to live life on your terms without worrying about money. For some people, that might require $1 million, for others, maybe half that amount is enough if they live simply. So, who really has $1 million in retirement savings? The answer is, very few. But those who do followed timeless habits. They started early, stayed disciplined, lived below their means, and never stopped learning. The shocking truth is not that so few reach it, but that anyone who truly commits can. The real question is, will you be one of them? Because the best time to start was yesterday, and the second best time is right now. Finally revealed, this is what separates the 1% of million-dollar retirees from the rest. Not luck, not high salaries, just consistency, patience, and belief in the power of time and compound growth. If this video inspired you to take your finances seriously, don't forget to like, subscribe, and turn on notifications. You're watching Stock Predicator, where we break down money myths and reveal real strategies to build wealth smarter, faster, and stronger. Stay informed, stay invested, and I'll see you in the next video.